Hey, this is Greg. Welcome to the channel. In this video, I'm going to talk about what I consider to be the greatest trading tool ever invented. Okay, so we've all been suffering through the bear market, and this channel has done a lot of videos concerning what's going on in the markets and the direction of the markets. And everyone's looking for an edge, everyone's looking for new ideas, and that's what this video is all about. Now, most people are familiar with the Invesco QQQ, which is basically an ETF which tracks the NASDAQ 100. The QQQ has been for many years a very effective way for an individual investor or even an institution to trade the NASDAQ. Then in 2010, they came out with the SQQQ, which is basically the ProShares Ultra Pro Short QQQ ETF. This was established in 2010 by ProShares. The Ultra Pro Short QQQ Index is an inverse leveraged exchange traded fund that tracks the NASDAQ 100 index. The inverse leverage strategy for the SQQQ means it attempts to reproduce a daily investment result that is roughly the opposite of the daily performance of its underlying index, which of course is the QQQ, and then multiply those results by a certain factor. The stated objective of the SQQQ is to triple the opposite results of the NASDAQ 100. So what this is basically a leveraged ETF. It's leveraged 3 times, and it performs inversely to the QQQ. So for every dollar that the QQQ goes up, this would go down $3. And conversely, for every dollar that the QQQ goes down, this would go up $3. So the thing that I find so fascinating about this is in the old days, before something like this was invented, if you wanted to go short the QQQ or any security, you had to literally go short in a margin account. In other words, you had to borrow the shares, you had to sell them in a margin account, and then at some future point, buy them back. This is more complicated, and in addition to that, you didn't have leverage associated with it. There wasn't this 3-to-1 ratio that we have in this SQQQ. So this is a tremendous innovation, and the sort of cousin to this one is the TQQQ, which is again a triple leveraged ETF against the QQQ, but it's the positive one, the one that is leveraged to the upside. Both of these securities can be used as very effective trading techniques, but in this particular video we're going to focus on the trading of the SQQQ to the downside and using it as a hedging technique to protect your portfolio. So what I want to do is I want to first take a look at the QQQ itself, and then I want to compare it to the SQQQ to help you understand exactly how they're achieving this triple leveraged inverse scenario, how they're doing it, and I want to make sure that you understand the risks that you're taking when you utilize this ETF. Okay, so here we have the Invesco QQQ. Okay, this is the ETF upon which this triple leverage version is based. You can take a look at where it closed today, 268 roughly. What I want to do is I want to just take a look at this. Of course, what this QQQ seeks is to generally correspond in price and yield to the NASDAQ 100. So it is intended to exactly mirror, to the greatest extent that it can, the NASDAQ 100. And if you take a look here at the 10 biggest holdings, you see the usual suspects here, and this is really, this mirrors what the index has, and we have Apple, the usual suspects, Microsoft, Amazon, Tesla, Google. We have the C-class shares and the A-class shares. We have Meta, we have Nvidia, we have PepsiCo, and we have Costco. Okay, very interesting, but the top holdings are basically Google, Tesla, Amazon, Microsoft, and Apple. Okay, so just remember that, and now we'll take a look at the SQQQ. Okay, now here is the SQQQ. Now if we do the same thing that we did before, and we take a look at the top holdings, we see that the top holdings are not securities, but they're in fact swap arrangements, okay? And these are derivatives, okay? So it's very important for you to understand that if you go into this and if you start utilizing this security to either hedge or trade, you have to understand that there are two risks that you're taking here in addition to the risk of the underlying security, okay? You're taking counterparty risk, okay? So in each one of these, here we have Goldman, we have Barclays, Citibank, UBS, Societe Generale. You're taking counterparty risk on all of these banks because they are selling to the fund a derivative that inversely matches the NASDAQ 100. Okay, they construct a derivative that has those characteristics. So there's two main risks that you're taking. One is counterparty risk. You're taking Goldman Sachs risk, Barclays, Citibank, and you can say to yourself, well, those are major financial institutions. I can deal with that risk. And then in addition, you're taking the risk that whatever hedges and whatever financial arrangements these institutions used to set up these derivatives, the hedges could go out of whack. Something bizarre could happen. There could be a market meltdown. All of a sudden the hedges don't work anymore. And whatever this derivative is that they're supplying here blows up. So that's another risk. Okay, so you have market risk or basis risk, you can call it, and you also have counterparty risk. Okay, very important for you to understand before you get into this. Okay, so because we're in a bear market and because everyone, including myself, is concerned with protecting their portfolio or making money in a bear market, I'm going to focus on this SQQQ and not, in this video anyway, I'm not going to talk about the TQQQ, which is the opposite side of the trade. Okay? So, there are two major things you can use this for. Both are very effective and both are very interesting. Okay, the first is to just trade the security. Okay, you can look at the trading range of where it's trading, and you can basically trade the peaks and troughs of the trading range the way you would trade any security. And let's just take a brief look at what it's done in the past year. Okay, so here's the year chart on the SQQQ, and you can see a lot of peaks and valleys, right? And you could have traded this very effectively. Let's look at 9 months. Look, this represents a rally in the QQQ, right? That would have been an entry point. You could have ridden it up short term to here or anywhere around here, sold, made a really nice profit. Same thing here, you could have caught this. Same thing here, you could have caught this. So you can make a lot of money trading this, and you know, if you have the interest and the stomach for it. For example, here you went from you know, what, low of 34. You're not going to catch the absolute bottom, but you know, call it high 30s. And here you're above 60. So you could have doubled your money in a period of about 2 months. Okay? That is really remarkable. And the remarkable thing about this is you're shorting the market, but you're going long an ETF. It's an absolutely marvelous way to do it. And if you're into this kind of thing and you're willing to take the risks, it's a great way to play a bear market. Okay, so let's talk about hedging, okay? I have been using this all year as a hedging mechanism for my portfolio. I have a long portfolio, largely focused in energy. I have a relatively small exposure to super high quality tech companies like Google, Alphabet, the A shares. I prefer the A shares because they're the voting shares. And I have a couple other smaller positions. So I view this SQQQ as a perfect way to hedge my high-tech, my blue chip high-tech positions, because it almost tracks it one for one, because these high-tech companies are a very large component of the QQQ. Make sense? So the methodology of how you would do this, I didn't do it exactly this way in my portfolio, but one way of doing it is, say, just theoretically, you had a $100,000 portfolio of equities, and those equities were heavily weighted to, you know, Google, Apple, Amazon, those types of stocks that equated in some way to the NASDAQ 100. What I would do, since it's triple leveraged, is just do a 3-to-1 ratio. In other words, if you had $100,000 of exposure to NASDAQ 100-like stocks, put 33% of that, or 33% of additional money into this inverse SQQQ. So if you had a total portfolio of 100,000 of long equity positions, you put on another 33,000 of this long SQQQ, and you would have a very good hedge against that portfolio. Now, what I did was I put the position up against not only my high-tech stocks, but also my large exposure to energy. And in doing this, not only was I hedging my portfolio, but many, many days when the market sells off and people get concerned about energy prices and oil goes up, there are many, many days when the market sells off tremendously and my portfolio goes up, because my oil stocks tend to react inversely to the market, and I have this inverse trade in the SQQQ. Very interesting, and the effective use of this hedging technique has caused me to earn over 60% in returns this year alone, when, as we all know, the NASDAQ's down over 30%. So just to go over the risks again, you are taking counterparty risk, and you are taking basis or hedging risk on the arrangements that are within this SQQQ. So that's the first thing to realize. Second thing is, of course, if the market goes against you and all of a sudden there's this huge rally, this security is going to go down not one time, but 3 times the decline in the QQQ. So that's, you know, you benefit on the way up, but you also get 3 times more punished on the way down. That's very important to keep in mind. And finally, the other thing is the fees in this are relatively high. I haven't noticed that as a big problem since I've been using it, but it is something to keep in mind if that's something that you focus on, and particularly over the long term, you could incur a lot of fees here. So I guess to wrap it up, I recommend this as either a trading vehicle for experienced traders or as a hedging mechanism for individuals that have a fairly robust equity portfolio in a downturn or a bear market like this. You can use it as a very effective hedging mechanism, and you can reduce your losses when the market takes a big hit. Okay, well, I hope you enjoyed this video and got some value out of it. If you did, please like and subscribe. I'd love to have you on board for future videos. And until then, thank you very much, and I look forward to seeing you on the next video.